Hello, I'm Kenneth Himmler Sr., and I'm the CEO and founder of Integrated Asset Management, a wealth management and financial planning firm. Today, we are going to talk about the differences between asset allocation and trend following. I want to start off by helping you understand that there are certain methodologies and principles that you can follow. There's not the blindfold just throwing a dart at a board hoping that your money lands on the right stock or the right fund. Now I'm going to reference an actual analysis that was done back in the mid-80s, and this was done by an analysis firm called Brinson, Hood, Biebauer. You can actually Google that if you want to actually read the entire report, but I'm going to summarize it here for you. What they did in this firm is they did a statistical analysis looking back upon the prior 20 years, and they used 91 of the country's largest pension plans. The reason that they used the largest pension plans is because statistically, when a management firm has greater than $2 billion under management, they have on average 50 managers overseeing that portfolio. They also have a very large budget that's allocated towards intensive research, constant overseeing of economic indicators and price changes. They didn't want to look at the average daily investor because most investors don't really have principles that they follow by. What they did was they took these 91 pension managers and they categorized their investment strategies and principles into 3 categories. The first is asset allocation, which I'm going to get to last. The second is stock selection, and finally the third is market timing. Here's what they did. They took that 20-year history and they found that less than 2% of all the returns were attributable to market timing. What I mean by that is people that will want to buy, and as soon as the price goes up, they sell a little bit. And a market timer is defined as anybody that holds an investment or a stock for less than 1 year. That's market timing. The second item was stock selection. And I'm rounding these percentages so we can summarize it. They found in this Brinson Hood Biebauer analysis that less than 4% of all of the returns were actually attributable to the stock selection. There are only so many Warren Buffetts in the world. And even Warren Buffett has made many mistakes, but he can afford it because he has that diversification. The analysis proved that there's only a certain number of winners, such as Google or Apple or Microsoft. These are high flyers, and they're usually promoted with the hype, much like the lottery. You always see the lottery winners. What you don't see is the millions of people that don't win a dime from the lottery. This is the same way with stock investing. Third, but not least, is asset allocation. Over 94% of all attributable returns were allocated towards asset allocation. Now, over the years, because asset allocation and modern portfolio theory has proven to, on a long term, be the best way to invest, to smooth out the volatility and risk, and have the best overall returns, there have been many derivatives of asset allocation. One is strategic asset allocation. The other is tactical. Let me explain both. Tactical asset allocation means that you're not necessarily a day trader, but you may weight either under or over certain asset categories based upon what's trending within the economy. As an example, if the government is issuing or printing a lot more money, you may short the currencies. You may also buy a long and a short treasury. If, as an example, interest rates are extremely low, you might reduce the amount of your bond maturity duration to less than 4 or 5 years. Pure asset allocation is either strategic or tactical. On the flip side to this, you have what's called strategic. Now, strategic does not necessarily trend with what's going on with the economy, but it picks certain asset categories, might be small, mid, large cap, might be short, mid duration bonds, might be some foreign currencies, etc. The only time that you trade within a strategic asset allocation model is based upon a percentage change or it's based upon a calendar change. Let me explain. Some asset allocation models say that they will rebalance on the same day of each quarter of each year. The second says that they will trade or rebalance when a certain percentage in an asset category gets out of balance. Let me give you an example of that. The first is much easier to understand because it just happens maybe the first day of each quarter of each year. The second, which is a percentage rebalance, says that if you have, say, an allocation towards small cap stocks, and that small cap stock has a 5% allocation. Furthermore, you might have an allocation of long-term bonds of 5%. Because markets trend and change, you might say, I'm not going to make any changes until either one of those makes a change by greater than 2%. Not 2% of, but a total of 2. Let me give you an example. Let's say that the long-term bonds drop because the prices drop from a 5% allocation to a 3% allocation. The small cap stocks increase from a 5% to a 7%. So what a percentage rebalancing rule says is you will reduce the amount by selling in the small cap from 7 to 5. You will use that money to buy more long-term and increase from 3 to 5. Now, the rules say and statistics say the more you trade, the lesser your rate of return gets over time for 3 reasons. 1, commissions. 2, inaccuracies. 3, no one can trend. Hopefully that helps you understand the differences between asset allocation, market timing, and stock selection. Thank you again. My name is Kenneth Himmler, Sr., CEO and founder of Integrated Asset Management.